All right, good morning. It is Friday, January 18th, 2019, about 10 a.m. Central Time, 11 a.m. in the East. And here's why oil is headed to $80. That's what we talked about this week in our one of our columns. Dave Zannoni is co-hosting along with I'm Kirk Spano, if you haven't listened in before. And, you know, I get a lot of guff, I guess would be a word for it, when I talk about oil heading to 80. And about 2 years ago, after oil bottomed, you know, I'm telling people oil's heading to 80 back when it was $50 a barrel. And it gets up to, what was the high? Did it get to like 77 or 78?
Mm-hmm. Yeah, I think it was about there.
And so,
that's WTI.
yeah, so it gets, well, yeah, the WTI got into the upper 70s. And I said it was going to head towards 80. And in October, right before it turned over, I think it was about $77, $78. I talk about that. I think I actually gave the price there. Yeah, $76.40 per barrel is what we got to. So, of course, the people in the comment section, not the people, a handful of people in the comment section tell me, oh, you were so wrong. Oil didn't get to $80 a barrel. And I'm like, man, when it was 36 and 40, I said it's going to 80 and it's going to take a year or two. So at 76.40, I'm wrong.
All right. But you could always say Brent went over 80. So
excuse me, yes, and Brent did get to 86.
Yeah.
So we can see on the chart. I mean, come on. When I'm saying 80, oil's going to 80 down in here, and it gets up to here before turning over, you know, that's, I think, pretty good. Now, I will say, I still think oil's going to head towards 80 for a number of reasons I lay out in the article, and Dave and I have talked about, and we're already seeing the turn up. So when you take a look at this trend here, this is just a big correction, right? And it hits these support levels again, and now it's bouncing back off. So I would expect another line like that, go back up in this 80 range. And unless there's a war in the Middle East, unless something really tightens up, unless the economy really gets faster than we think, the price of oil probably is going to be in that 80 range. And I've been talking about this peak oil plateau where supply and demand would be in balance. And Saudi Arabia talks about that, how to keep the supply and demand in balance. And one thing for, I think, people to keep in mind is that until the EVs really come with those Zinca air batteries that are going to really dramatically reduce cost and weight and get rid of toxicity and increase range, you know, we're going to have rising demand for oil for several more years at least. I suspect until late in the 2020s, so another decade of rising oil demand, but very slow, very, very slow rising oil demand. You know, maybe an extra million barrels a day. You know, next year we're looking at 1.3, 1.4 million extra barrels a day. And that's down from projections that were at 1.7 and 1.8. So you really have to consider that the growth rate is slowing, but demand is still increasing. And I think that's a concept that people get mixed up once in a while. The demand growth is still going up, just not as fast as it was, right, in prior years. And I think that's important. Now, if any of you can hear music in the background, I'm not sure if you can or you can't, that's because I am on top of the Costa Hotel in Hollywood Beach. I don't know if I said that on or off air earlier. Beautiful place. Last time I was on Hollywood Beach was about a decade ago, and I will tell you that the refurbishing of this beach, they're growing some dunes to protect it, just massive remodeling. There's a $14 million community development program that's redoing the whole boardwalk area. I'll tell you what, Hollywood Beach between Fort Lauderdale and Miami is it's a great location, number one. If you're a poker player, you got a number of casinos, including the Hard Rock. I actually skipped the Hard Rock. You know why I skipped the Hard Rock this time, Dave?
Why is that?
Because the World Poker Tour is there. And this is going to have a correlation to trading and investments too. But one of the great poker players of all time, Mike Caro, said, you know the secret? You tell me if you know the answer to this question. What's the secret to making money at poker? play.
Face, right?
No, play with people who are worse than you.
Yeah,
right?
of course. Yeah.
There you go.
Yeah.
So the Hard Rock is full of World Poker Tour players right now, and I play a little Midwest, mid states poker tour, which is Midwest, and probably get into the Heartland Poker Tour. Some of the kind of like the minor leagues of professional leagues.
Mm-hmm.
Like if I was an NBA player, I'd be in the D League. If I was a Major League Baseball player, I would be single A or double A. If I were a football player, I'd be playing in Canada, So, I'm not NFL, MLB, World Poker Tour quality, but I'm pretty good. And I'm the kind of guy at the kitchen table. If I'm drinking, I'm okay. But if for some reason I want the money, then I'm sorry. But anyway, trading is like that. Investing is like that. You got to be better than the other people out there, which is why you don't want to be part of the crowd. And I think one of the big contrary trades right now is oil. A couple other services are talking about it. A couple other big investors, including Gunlock, are talking about it, that oil is probably a place to have some money, particularly if there's a thaw in trade relations. And we've talked about that a lot now, haven't we, Dave?
Mm-hmm, definitely.
So if you take a look at the screen now, China is breaking news right now. China has offered a path to get rid of the U.S.-China trade deficit. Now, they're saying within 6 years they'll go on such a buying binge of American goods, which is mainly going to be agriculture and energy, two places that we're heavy, those boring investments of agriculture and energy, but we're in them. We own Nutrien, which I think has a lot of catalysts. Some of our more aggressive folks have some soybean options, on SOY. And I think that if really, and that probably popped today, I haven't even looked, but if you're looking for something very aggressive, a swing trade, I would take a look at the soybean ETF. And if you really can understand it, you have to do a cram course over the weekend, but if you can really understand it, I think there might be a trade in the soybeans for you that, using calls, you probably double your money in 3, 4, 5, 6 months. Of course, there are options. You have a chance of losing everything, so it's got to be a small bet, right? So if you put enough bets out there, 5, 6, 7, 8 bets at 1 or 2% of your portfolio, and they all have a chance to double, you still need half of them to double if half to go to zero.
Right.
So you still have to put the odds on your side. And one of the things in the article this week we talked about is how do you put the odds on your side, right? So if we take a look at some of these charts, and I don't want to look at that one. I want to look at this one. Quick thoughts on E&P stocks. So if you're a member of either one of the investing services, you get these quick thoughts articles. And they're just bite-sized morsels that point something out that's important. So many of the oil stocks out there are kind of a mixed bag of technicals as of yesterday, and right now they're all turning back up. So we might see overbought oil here in the next week or two, and then for sure we really want to trim some of those positions. But we get money flows and MACD indicators that rise up or come off of bottoms, and remember, Paul Tudor Jones, the place to make money is at the pivot points, right? The changes of directions are where you make the most money. And those changes of directions are really hard to find. But if we use MACD, and this is Occidental here, which leveled off, and now all of a sudden it's popping back up, we can see that we had a good divergence in the MACD, and it started to level off, but now it might get a little extra rise. You can see over here, started to come down, but then you get more rise. And sometimes these lines wiggle a little bit. They're not always super smooth, right? It's not a bell curve always. So we might get one of these occurrences where everything looked like it was going to start to turn over. And I think we don't get this news, right? If we don't get this China news, they probably have a little bit of a correction.
Mm-hmm.
But today we get the China news, which is why I tell people scale in, scale out. So we took a little trimming to the portfolio yesterday, just a little trimming, and I think that maybe in the next week we trim a little bit more as some of these items become overbought. So we have the RSI, not overbought. But if these all of a sudden rise up to 70 plus, and we get a clear overbought signal, we get MACD with a divergence that gets another level up and then starts to turn over again. We get the shake and money flow, get up to some extremes, right? We get up into this area, then we really want to take a lot of profits. Down in here, it was just a trim because we were sort of in the middle of the market, and we had a handful of profitable trades from the last few weeks. And, I had trades that were up 20, 30% in the last, 3-4 weeks.
Mm-hmm.
And I was trying to get back money on trades that were down 30, 40, 50% from the month or two before that. So I closed the gap, and now we're going to get this rally, it looks like, because of the China news, unless, we get another headline in a couple days that says, oh, baloney, or Trump doesn't like the deal or something. Well, all these things can happen, right? Mm-hmm. So when we're working on our portfolio, it's risk management. And taking 20 and 30% gains, I think that I missed a chance to do some of those back in the fourth quarter. And then I got bit in the butt in December, right? And I acknowledge it. Hey, we missed a trade in December. So we try to fix it. And one of the things you can do is, take some profits on your new trades. I think the worst thing that people may have done at the end of December is they were so shell-shocked that they didn't make the next trade. They didn't make the hard trade because emotionally they couldn't do it. And I keep talking about controlling your emotions. The right trade is the right trade. Even if you miss the last right trade, the right trade is still the right trade and you need to make it. And you scale in a little bit at a time, scale out a little bit at a time so that you kind of smooth your curve. And you're not always trying to hit home runs, right? We can't always be Henry Aaron. A lot of times we need to be Rod Carew, right? Lots and lots of singles, or Ichiro, lots and lots of singles. And every now and then we get a double. So we have to just keep getting on base. And every now and then the market does something usually fast that's out of our control. A good trade turns into a great trade a lot of times because the market does it. It's not us. We want to take credit. We want to say how smart we are. But really just putting yourself in a position over and over and over again with good trades. And every now and then some of them turn great. And it's usually not us. It's usually the market doing us a favor. So, take a look at Devon Energy. Look how much it came off the bottom. Week of Christmas. Bam.
Mm-hmm.
Look at some of these charts. And they all look similar, not all the same. Continental Energy is the one that moves mostly with oil price. It's the most correlated to oil price of the big stocks. And Kana, which is the one that I think is going towards 20, just crossed $7 today. And you can see, positive divergence emerges.
Mm-hmm.
Looks like it's going to keep going up now because it's going to have an up bar today. But not yet overbought, right? We're not over 70 yet. We are, on this, I'll see if I can move this a little bit for you. We have over here, money flow can get much higher. So,
and it did just cross into the positive territory. So.
Yeah, we've already passed the positive, but money flow can get way up here, right? Mm-hmm. If you get some good FOMO, let's suppose there's a China deal. Let's suppose that Mueller doesn't say that Trump should be impeached. Let's suppose that the Federal Reserve stays on pause and is real dovish in the way they talk. Let's suppose a bunch of negative things that are priced in after that correction never come to pass, or only come to pass minorly. Now remember, we talked about this 4 months ago, back in September. I said that the fourth quarter, all the corporations were going to set their earnings bars that they had to get over lower, and they did. So we have earnings starting right now, and we'll talk about this next week. This is going to be the focus of next week, is to talk about earnings. If these companies can get over these bars that they set, and all the negatives are what's out there, then really only positive news can come, and then you get a rally, right? So in my forecast for this year, which I haven't published, I've only talked about, I do think that there's a very good chance that we get a huge rally to over 300 on the SPY, 3,000 on the S&P 500. But I do think I agree with Jeremy Grantham out here. I have a Jeremy Grantham article marked somewhere. But Jeremy Grantham, who has gotten an awful lot of things right, is talking about we're in the stages, right? We're in that process of the stock market topping out. And he's talking about getting more into the international stocks. And I think that probably makes a lot of sense over the next year or two, is we still want to invest a lot in America because it's the most, I think, safest market because of property rights and the legal system. And, in general, we'll get our corrections, but it goes up over time. So, I don't want to throw the American market out, but as I've talked about with the slow growth forever economy and things like that, we're going to have to be hugely selective. And that's why I've been shifting my focus away from old economy stocks and towards newer economy stocks. And technology is a huge, play there. But technology impacts every industry. And really with oil, David, you've seen this. With oil, the big change in oil has been the technology, right?
Right.
The oil was always there. Now we can get it because the technology allows us to.
Right. You got the shale technology, so we're going deeper, the horizontal drilling and all that stuff. So it's all really, being able to get more oil and, in a more efficient way.
Right, cheaper, right. More oil,
exactly.
cheaper.
Right.
So when David and I are talking about oil stocks, we're not exclusively talking about Permian oil stocks, but mostly talking about Permian oil stocks. And we want to look for oil stocks that have really good balance sheets, that they're going to get the point of being almost debt-free or net debt-free, right? As much cash as they do debt in the next couple of years. Because, of course, oil isn't forever anymore. It used to be people thought oil is forever, and we know that it's not anymore. Demand for oil is going to turn over in the next 20 years. I think by 2050 we'll be using around 50 million barrels a day versus the 100 million barrels that we're using today. So I think by 2050 we're using half as much oil. And largely that's because the motor vehicles will go mainly to motors from engines, and that'll be electric. Again, that has to do with the battery technology, which is improving so fast. I know that it doesn't get a lot of headlines, but those zinc batteries, I'm just telling people, look into zinc batteries. And they're going to be a big deal between the flow batteries for, maybe home storage and building storage. Then you have the zinc air batteries, which are going to replace the lithium batteries in cars relatively quickly. In fact, I think that GM, Ford, and some of the other companies that they're kind of behind in their electric vehicle development. When they start with their electric vehicles, in earnest, GM they have some batteries, but when Cadillac comes out with their next generation, and that's going to be the flagship for GM electric cars, when they come out with their vehicles, I wouldn't be surprised to see them skip the lithium phase, right? They have some lithium now, but when they go to mass production, I think the mass production might be zinc because it's lighter and it's non-toxic and it's a little bit more efficient if they do it right. So if you can have a car that gets 400 miles to the charge, and that car is only $1,000 or $2,000 more than an internal combustion engine vehicle, now all of a sudden you're going, all I gotta do is strap a solar cell onto my garage, and I have a car that's powered all the time. It's interesting the way things are going, and really as investors, we have to measure how fast it's going to happen, right? And if we're a little early, as long as we get in cheap, we're good. We don't want to be chasers on some of the rallies because a lot of the rallies are going to fall back. This whole getting into the sustainable investing world, it's coming. But we have to, unfortunately, be pretty good traders to make this work for us. So building around core positions and then trading around them, I think is going to be very common in the next decade. I hate to say that we're going to have to do some swing trading, but I think we're going to have to do some swing trading as we go through this transitionary phase. And, and it's similar to bull markets switching into bear markets. You get that choppy phase for a while, which I think we're in between a bull market and a bear market. And I think the same transition from the old fossil fuel economy to the newer sustainable investing, alternative energy, smart grid, battery-driven economy. I think that's going to be a long transition. It's not going to be a 1 or 2 year transition. It's going to be a 10 to 20 year transition. And I think there's going to be huge long-term opportunities, but there's also going to be opportunities where if you trade well using some of these indicators, and I'm not saying day trade, I'm saying, you make these trades over a matter of months or quarters, you probably can increase your gains sufficiently. So going back to oil, we go through all these companies, and I think we just want to talk about a couple of companies where we think we can make the most money. And I'm going to start with Encana. When you take a look at Encana, you want to take a look at, let's see, I probably need a smaller chart, huh? Well, there you go. You see how it really tailed off here? I mean, it really had a massive correction. And take a look at how high that volume was several months ago. That's a massive correction. This stock was in the middle teens, 13, 14. It's down around 6, 7 right now. It's around about 7 right now today, 705 or something. It jumped up to on the China news. This stock is going to go back to 13, 14. I think it's going to go up to around 20 because they are such a good takeover target. Their plays are very good bolt-ons to other companies in the Permian, the Eagle Ford, and the Montney up in Canada. So, to me, Royal Dutch Shell has talked about these being the places they want to be. I think Royal Dutch Shell makes a lot of sense to buy these guys out. I don't know how high it goes, but I would say, at least back up to near its highs, because I don't think the board would sell the company before they're approaching the highs, right? So I think this is a stock that you can double just by owning the stock. But if you're buying some of the 2020 and 2021 calls at around $8 or $10, when you take a look at those prices, they're pretty cheap right now. Not as cheap as they were a few weeks ago, but they're still pretty cheap. And if you think that this is a breakout, and to me it looks like it's probably going to be, I would take a portion of your position, probably want to have twice as much stock or 3 times as much stock as you do options. But if you want to add a little juice, I think you can buy calls on this one. Then I don't have this one here. Where do I have it? I have it somewhere. Diamondback. So Dave, why don't you take us through Diamondback? What is the excitement about Diamondback
right.
that we should know?
That's they have sufficient Permian operations, and which is one of the biggest oil operations basically in the United States. So and they have a big it's a big play. It's going to be I think they'll do well. It's going to carry. I think it's going to do well during this oil bull market, basically. So it's going to recover. It already has recovered, and I think you can ride it up. Most of there's a lot of plays. I mean, I think most oil plays. It's not the only one that's going to work. I think most of them are going to work in this environment. So as long as you have a good support level, we're already at oil over 50. Expect Diamondback to do pretty well. It looks like it's consolidating a little bit right now. See on the far right-hand side of the chart there.
Right, and I think if I reload this, I mean they're up $1 today, right?
Right, right.
I mean this is to me a stock where you can buy as an augment to maybe an XOP position, right? You have an ETF to build around. So if you build around XOP, this is one of those stocks where I think you should take a look at the call options and see if they're priced well. And compare all of the stocks. So I will finally publish for the public the Dirty Dozen Oil Stocks article. We talked about it in a webinar about a month ago. So if you want a sneak preview, go look at our webinars on YouTube, and you'll see one of them titled the Dirty Dozen Oil Stocks. Take a look at that. But I think Diamondback is one where you buy a couple of calls, buy a little bit, 1% of the portfolio, 0.5% of the portfolio, and calls on Diamondback. Maybe have a basket of calls on several stocks, 5, 6, 7, 8 stocks to put around an XOP position. Or as you build your basket, just remember to have non-leveraged investments be a 2 to 3 to 1 more than your leveraged investments, right?
Mm-hmm.
Your options are your leveraged investments. That should only be, maybe a quarter of a basket. You don't really want to go too much past that, because then if those go to nothing, right, you get one of these December events where you just can't get out of the way because, we're emotional, or we just miss a signal, or we talk ourselves out of following price because, it can't happen. And I think that's what I did. I was like, this can't happen, and then it did. And the funny thing is, I talked about it happening just several months ago,
Mm-hmm.
and I just couldn't get out of the way. So we have to not screw up on those types of trades. It's like the third trade I've messed up in 15 years. So,
Mm-hmm.
I mean, I'm not going to beat myself up too bad, given that we basically doubled money in 2000, from the middle of 2016 to the middle of 2018. But, we need to mind these money flows. So what are the reasons why we keep focusing on the Permian? Just to repeat ourselves, and I know that we get tired of repeating ourselves. We got to remember to do it. So we have new listeners, new subscribers, new people thinking about subscribing. The Permian Basin is the cheapest place in the United States to produce oil. So you got two major centers of that basin, the Delaware and the Midland, and you have really cheap oil. And it's where about 3/4 of new U.S. production comes from. Another 20% comes from the Gulf, and then 5% of the new production in America comes from everywhere else. So you can see why, if you can find a lean Gulf producer, right, which is just focused on a handful of great wells and great opportunities with a great balance sheet, you do that. But I'll tell you, I'm down here in Florida, and I've talked to a couple oil guys already. I'm telling you, the Gulf has got limited opportunity. The shallower water is pretty much played out. You have some, every now and then they find a spot. But then, the new wells that are coming online, they're talking, was it 5,000 feet down? I mean, they're talking deep. And those are off the shelf. I'm not so sure those really get done. We'll see if they can make those really break even at $40 and $50 a barrel like they're talking. And remember, if you got to put $200-300 million into a project, your first barrel isn't breaking even at $40, right?
Mm-hmm.
Your first barrel just costs you $200 million.
Mm-hmm.
So you got to produce a lot of barrels just to get to even, and then your barrels are breaking even at 40. So what do you really need? You really need 60 to get that first $200 million back. That's something I keep pointing out is so high that you have to produce. I don't know math in my head right now, but you got to produce a lot of barrels of oil before you're even. If your break even's 40, right?
Mm-hmm.
So you need a $60 barrel oil, first $40 just producing that barrel, and then that $20 spread or 15 or 10 or whatever it's going to be that you're making above your break even. You got to make that until you've made $200 million. The average well in the Gulf of Mexico is around $200 million. So, you have some that are down in the 50, 60, 70 range, depending on how deep, how complex, what kind of BOP, what kind of BOP they have, blowout protector. This technology is getting very complex and very expensive. And then they make it cheaper again, right? They invent it, they perfect it, and then they figure out a way to make it cheaper. Mm-hmm. So, I would say stick with the Permian for the most part. Continental Resources will probably be the first one that we sell out of because once the price of oil gets to where it's going to get to, $70, $80 a barrel or whatever, Continental's pretty much done rising because it rises pretty much lockstep with oil. The other companies with even better balance sheets than Continental and in the Permian, Continental is Bakken and Stack Scoop. And everybody talks about the Stack Scoop being the next big thing. Here's the risk with a Stack Scoop in Oklahoma that you have to keep in mind. Earthquakes. They're really having a problem with earthquakes in Oklahoma. And to mitigate the earthquakes, you have to take away the waste. Taking away the waste costs money. So that makes the Stack Scoop not as efficient as you'd want it to be if you could just throw the waste wherever you wanted, which is a negative externality that the rest of us end up paying for. So the government is trying to get rid of the negative externalities put the cost of production back on the companies and taking it away from the public. And in the long run, I don't know that it matters much other than we have a cleaner planet, right? I mean, financially, I don't know that it matters much. You know, you do definitely want the cleaner planet, right? I mean, everybody agrees with that? So the Permian is the best rock. It's the best place to drill for oil in America. Yeah, good regulations. It's very favorable to the oil industry. They're going to have to work on their methane recovery and their natural gas flaring, and that's going to become a more immediate problem, I think, in the next few years. I think the government regulation, which has gotten softer under Trump, is going to get tighter in the 2020s. So just keep that in mind, that these soft regulations on environmental controls aren't going to stay forever. There's going to be a pendulum back to more regulation, just like there always is, you know, and people want to fight it and they have their ideological arguments. I just look at it as, look, the cycle goes back and forth. The next time, you know, you're taking a look at some of the new Democrats to get into office. They want the new Green Deal. I want the new Green Deal. I just don't want the government to have to be the one to pay for it. I think you incentivize private industry to do it, you know, rather than, you know, saying the government should expand in size and spend more money. You know, you can set up a system where it's advantageous to do the right thing. And we just have to figure out, you know, how to get rid of the special interests and the largesse, and I think that we can do it. You know, so Dave, I was talking to somebody here in Hollywood Beach, and we talked a little politics for a minute, and he goes, so he says he's leans towards being a libertarian, and I think that as I've gotten older, I've gravitated in that direction, but I've always been a little bit liberal, and you know, I don't think anybody can really accuse me of being stupid. You know, I'm not a dumb guy, but I do believe that we should have a social safety net. We should have regulatory structure, but I think it should be a light structure. I don't think that we need a heavy-handed approach, and that's where I think a lot of liberals get out of control. Is they overspend on the government, and the regulation gets so entrenched in the bureaucracy that it doesn't work with business,
right.
So that business can do what business does well and does good, right?
I mean, you don't want to stifle growth. Yeah, I mean, you want it to be conducive for growth, but still, you know, you want to protect the environment at the same time.
Right. And you take a look at the way we live. You know, we're a rich country, and clearly wealth inequality is wrong to the extent it's gotten. But you have to find balanced approaches to getting things to move in the right direction. You can't tell the people who are busting their ass, hey, you know, thanks for busting your ass, now give that to us. And you can't tell people who aren't busting their ass, here's something for free. You know, there has to be this balance where everybody contributes, and those who want to work harder and have, you know, develop more skills over their lives or talents, or maybe they're just blessed, you know, whatever. I tend to agree that lucky people generally work harder, right? You put yourself in a position to get some luck in most cases.
Yeah, persistence, diligence.
Right.
Hard work. You know.
Right. And to the extent that we have institutionalized bad luck for certain people, which clearly we've done, right? We've held a lot of people back because of the way institutions are set up, bureaucracies, racism. You know, there are a lot of problems, and as people, we have to gradually get over them. And I think we're moving in the right direction, to be honest with you. I think a lot of the negativity is poorly founded. And so anyway, we got into this conversation. It was a pretty deep conversation over some crab legs, I believe it was. I will say, a lot of crab out here. I like it. But I said, you know, I think what I would categorize myself as is kind of a liberal libertarian. And he thought about it a second. He goes, yeah, that makes a lot of sense, because I don't really care what you and your girlfriend do, you know, in your private life. I just care that, you know, we're all working in the same direction as a country, that everybody has better standards of living, but that everybody has to put in some effort. And, you know, I think that when we take a look at the stock market, these socio-economic issues, they matter because we have to follow the way that the pendulum is swinging. And so I'll bring this back to oil. I'll tell you what, the regulations are going to get tighter on oil. So I'm saying, you know, and even though I want them to get tighter, that's not what I'm basing my decision, my analysis on. My analysis is that we have this pendulum that swings back and forth from tighter regulation to looser regulation, and hopefully we find ourselves in the middle. But as an economist, I know that we usually pass through equilibrium. We don't stop at equilibrium. And, so I think we've been on both sides, and I think we're going to swing back. Could we find equilibrium? That would be awesome. But usually we pass through equilibrium. And that's why prices on stocks fluctuate, right? I mean, let's say that the price of Diamondback Energy should be $130 because that's what that company is worth over the next 10 years.
Mm-hmm.
Then why is it 105? And why has it been 155?
Yeah. Oh, we had the correction. Yeah, the oil did fall down to the 40s.
Right.
So that's going to affect all these stocks.
Right. And it's about reversion to the mean. So when we go below the mean, right, when the pendulum goes too far in one direction, you have to kind of try to weigh that out. And I want to find a better, easier to read chart because there's a few of them over here. See, this is an extreme down here. We knew that this had to turn back around because it got to an extreme. Money coming out, extreme oversold. The RSI was under 30.
Mm-hmm.
When we get into these spots down here, we need to be buyers, even if it feels bad to do it. And when we get overbought and these numbers get into the 70s and 80s, approach 90, we need to say, you know what? I got to turn my fear of missing out off, and I've got to bring back – do you remember the acronym, Dave? Were you with us at the time?
It might have been. I probably forgot what it was.
I'm sure somebody can put the other acronym up. Instead of FOMO, when we get really overbought, we have to have FOGYAC. Fear of getting your assets kicked, right? and to be in polite company, I say assets kicked, not something else. But really, you just got to eliminate the T, and you know what I mean, right?
Yeah.
So, we're gonna cut this a little short today because I think if you go and look at this article, so I published this for members, but if you take a look at my blog, and make sure you're following Dave Zannoni and myself, and we're gonna have a third analyst or another analyst soon. He may or may not write for Seeking Alpha, but he's a technology and alternative energy guy, and he's pretty well connected with that industry. Go into the blogs, Free Friday webinar, this one, and if you're not a subscriber, I copied a subscriber-only post to the bottom of this, so you can get all these charts, and these are all stocks that we are invested in or trade. I want you to see some of the things that we're doing. One of the things we're doing is, where's Dave's article? Dave, where's your article on Google? I thought I had it up. Uh-oh. So Dave and I wrote an article on Google. He probably wrote almost all of it. I just did a little editing. Alphabet. There you go.
There it is.
So Dave did this SWOT analysis. So one of the things that we're doing with margin of safety investing and fundamental trends this year, and fundamental trends is the one that you're going to want if you want to do the swing trading. Margin of safety is everything else. So margin of safety is everything but swing trading. Fundamental trends is everything plus swing trading. And the new menu and the new website for fundamental trends will be up in February. So you can take a look at that then if you want. Otherwise, margin of safety, if you just want the great stock picks and the occasional trim for profits and the occasional buy when it's hard a recommendation. I think for 80, 90% of people, margin of safety is just fine. But if you really want to swing trade and you have the time to put in new trades every week, eventually you'll want fundamental trends because that'll have more of that profit maximizing. The add-on service to fundamental trends is called RARE, Risk Adjusted Return Elite, and that is an acronym that I came up with after, I believe, vodka. So, but they wrote this article about Google, talked about some of the strengths. Google is one of our core holdings now that it came down to around $1,000 a share. And one of the reasons that the section that I kind of helped out with was the baby Googles, right? That's a term that I'm throwing out there. I'll probably title a whole article, the baby Googles are coming. But there are a lot of divisions for Google. And I have that chart in here somewhere, don't we? Did we put the chart of all the Google divisions in here or not?
I don't think we put that in there.
We didn't put that in? Okay. So you can find them online. But Google has just all sorts of different divisions here. And they're going to start selling them off. And part of the reason you're going to sell them off is because they plan to do it all along. The reason that Google decided to call themselves Alphabet is because they knew that they were becoming a holding company. And while Google provides 97% of their profits right now, they're at the very front end of monetizing all of their other businesses. So Nest for the smart home, you have a number of other companies. They're going to be big in AI. They're going to be big in quantum computing when that comes around, and that's down the road.
Mm-hmm.
But some of the things that are coming are huge. So I would, if I'm you listening, go read this SWOT analysis that we put out there. This is a regular type of piece that we're putting on the margin of safety fundamental trends now, so that we have a base core piece to build off of. We know what the company's about, and then we'll do updates 2 to 4 times a year on each company. And Google, if Google's not in your portfolio, I don't really know what to say to you. You need to own Google. And maybe only for 2, 3, 4% of your portfolio, but it is a tech conglomerate. And they're going to start spinning off these pieces because A, it's part of their strategy, but B, to get ahead of regulation, they're going to do it. So they'll spin off Nest. They'll spin off something else. They'll spin off stuff. There's 6 or 7 that I think they spin off in the next decade. And think of it a lot like AT&T, another stock that we own. By the way, I am on an AT&T connection right now up on top of this building. And if it sounds great, then we have to give AT&T some credit because I am not on my Wi-Fi right now. I'm on a Bluetooth using the AT&T network. And I think that all these companies in the 5G space, it's just starting to emerge, and I'm on 4G right now, are going to be great. I think Verizon, AT&T, CenturyLink is as a backbone play because they have the wires that connect the towers. I think that all these companies are going to be great. But going back to Google, Google is a core holding. It's one of our 5 core holdings, and they all became buys in the last month. And even though they're all off of their bottom, they're all buy the dip stocks. So between Google and PayPal, which Dave wrote and I edited a little bit. You said that you submitted PayPal to be on the. Yeah,
it should be popping up hopefully today.
Okay,
I think on the free essay site.
Yeah, should have the PayPal article, and that article isn't a SWOT analysis. We're still putting the SWOT analysis together, but it talks about basically the growth catalysts, and I think that PayPal is a company that could probably triple in the next 5 years. Google is a company that could triple in the next 5 years. But I think there's reasons they could do better than that. And I think Google could go to 3,000, but by the way, throw off a couple of their stocks like AT&T did back in the day. Mm-hmm. I think PayPal, because of the exponential power of how they can pile up revenues without really adding a lot of expenses, I mean, I think PayPal could have a very Visa-like trajectory over the next 5 to 10 years. So if you wish that you had been invested in Visa in the last 15, 20 years, I think you should be looking at PayPal right now. I think PayPal is going to be that company. Think of it as investing in Visa in the first couple of years. The PayPal has only been public, about a year now? Year and a half, 2 years?
Mm-hmm, right.
It's not. I mean, I invested at the IPO. And so in 2 years, I've doubled my money on that one. And I think I'm going to double or triple or quadruple my money yet. And I think that's not going to take as long as you think. Because with PayPal, you have the whole move towards
Cashless payments.
Yeah, cashless payments, and then money transfers. Money
Yep,
transfers
exactly.
are a big deal. So,
And the blockchain efforts will kind of get them closer to a faster bank-to-bank transfer. Because right now, it takes a few days. You just send a payment out from your bank to pay your bills. It's going to take 3 days to clear. But I think this day and age, we should have should be instant. You think you'd send a payment, it should be there,
right?
Within a few minutes, at least the same day. So I think that's where their blockchain technology could steer them into that direction.
Right. So, all right. So we're going to shut this down in here in just a minute. We're actually going to make an hour this time, but I'm going to look at the chat if I can find it. Where's chat? Chat. Did anybody have a question so we can all right, so what is wrong with Sun Power? Nothing. $10 seems high to me. $5 for the valet. Talked about at the start of the call. Tesla down 10%. Hey, I wrote about that, right? Just a few weeks ago I told people to sell Tesla. I think it's happening for the reasons I said. Now, Tesla gets under 200, I'm going to look at buying it again. Not that I'd buy it at 199. I'm just saying that's when I start to sniff around. I take a look at the money flow numbers. Enbridge is on a tear. Love it. Yeah, Enbridge, in my mind, is surpassed with that merger a while back. Enbridge has surpassed Kinder Morgan, but Kinder Morgan's the other one I would own for the long term. Where's the investment opportunity with zinc air batteries? Trying to figure that out. Right now, the newest technology is owned privately. So probably probably with the zinc air batteries and the other types of cheaper batteries, a lot of it's owned privately because a lot of private money knew that it's important, so they are private equity. So if you're an accredited investor, if you're a millionaire, and you want to talk about private equity investments, contact me through my website because I have private equity investments for that.
你要是不吃的话，真的是有味儿。对，然后它就
Somebody got unmuted. All right, there we go. What is the best way to find? Well, you just do the math, compare it to a whole bunch of other options. The way you figure out which options are priced well is you have your value for the company, you have your trajectory for the company, and then you take a look at which options are not pricing that in. And you have to do a lot of pencil to paper. And Kana is running out of well locations in the Eagle Ford. Okay, so somebody was writing about that. So what? What is Encana's big play? It's all the well locations they have in the Permian. So for somebody to say, oh, look, Encana's running out of well locations in the Eagle Ford, shit, we knew that a year ago, 2 years ago. So some of this news that you read about, it's because somebody wasn't doing their homework and they just figured it out. Now, that said, sometimes the market reacts to old news, right? The big reason to own Encana is the Permian. Eagle Ford, I think they could sell off by itself and just have the Permian and the Montney. I think that would be awesome, actually. But, we'll see. Let's see here. Somebody knew Fogyak. Oh, a couple people knew Fogyak. Yeah, fear of getting your ass kicked. Assets kicked. David doesn't like that I swear sometimes. But a study has been done, a number of studies, that people who drop a naughty word every now and then, they're trying to demonstrate to you that they're being really genuine and honest. And it's a tip-off that they're not trying to be too buttoned down and hose you. I'm a Midwest guy. I grew up next to farmers. I'll tell you, every now and then I drop a word in there. It's like I can't say exclamation point, right? So maybe I say shit or I don't want to get any. I don't want any other 4-letter words because that's a little bit too much. I'm still a Catholic kid trying to figure that one out too. PayPal article for Dave just appeared.
All right.
Ooh, let's see here. 4 reasons PayPal could end up in Buffett's Berkshire portfolio. By the way, I'm going to take partial credit for that title.
Yeah, you got the title.
But I do think these are real time. You know, Warren Buffett loves financial companies. Mm-hmm. PayPal is the new financial company.
Right. He's got all the credit card companies. He's got the Visa, American Express,
right,
MasterCard. Yep. So PayPal would be natural.
What exactly? I agree with you, Dave. I think that this article that you wrote is spot on. The section on blockchain is important, right? They're not making money on it now, but they're at the edge. I think if something with that happens, they make the transfers instantaneous from bank to bank or bank to institution. Mm-hmm. Man, I think PayPal could go exponential. I think you have to have PayPal in your portfolio, even if the handful of competitors catch them, mm-hmm. And then you have to bail at some point. But they have such a lead,
right?
Such a lead. And I do websites where I take subscriptions. And I'll be honest with you, I don't like some of PayPal's policies because they're basically forcing me to have a money-back guarantee, at least early on in a subscription. Mm-hmm. But Seeking Alpha does it to me too. So I'm like, okay, so I'm giving everybody a money-back guarantee, even if I'm not really advertising it, because of the way PayPal does things, because they're so above board. And that trust factor with money, right? Big deal. It's a reason why I think cryptocurrencies have a problem. It's because who do you trust? Mm-hmm. I mean, blockchain, we've seen multi-million-dollar thefts of not blockchain, of Bitcoin. We've seen multi-million-dollar thefts of Bitcoin, right? Just mm-hmm. disappears. And we don't know where it came from in the first place. And we don't know how much there is. So, I think that there's an intermediary that's going to emerge here that uses the blockchain currency or the digital ledgers that can do that. Kirk, I had sent you an email last week. Can we get in touch? Yes. I'm on vacation basically, and I'm a little bit behind. Why is CTO so volatile? Okay, so we're going to finish off with CenturyLink because it's the stock that I've been recommending at this price level for a year and a half. It's gone from 15 to 23. And it's just bouncing around. Now it's at the bottom of that range. Let's even do a chart here. So let's shrink that. CenturyLink is basically 3 things. One, they have the biggest, after AT&T, the biggest international fiber network, right? It's all over the world, 100 and some odd countries. So they are an international play. They offer the backbone infrastructure that wireless companies need. So they are a natural fit for a lot of these regional telecoms, when you have to kind of stay in your area before you get roaming charges or before you get throttled. CenturyLink is a natural partner for them. And I still think Google Fiber's unit, which I think they changed their name to Access or something. Dave, what did Google Fiber change their name to? Are they Access now?
I think that is it, yes. Mm-hmm.
Yeah. So I think that CenturyLink is the perfect company for Google to say, hey, we're going to spin off Access. We have all this cash. Why don't we buy CenturyLink as part of the process? And now all of a sudden you have CenturyLink's assets with a better balance sheet. Oh, my. Right? Mm-hmm. So I think, all the companies we own, not all the companies, I should say all the companies, but most of the companies we own, the reason I take a look at these companies is because I can see, or I try to see, if there is a mergers and acquisitions angle to it. Is there a strategic angle to it? And if there's a strategic angle, that's just a catalyst that isn't priced in, and every now and then you get one right, and bam. When I talked about GameStop a year and a half ago, I told everybody they have to do some strategic work. And they've basically done one of the things that I actually sent letters to 2 CEOs. I said, look, you guys have got to sell off the cell phone unit, the AT&T stores. Spring Mobile is what it was called. My son worked there. So you guys got to sell off Spring Mobile, take that cash, focus on your core business, and really push the online subscription gaming. And that's what they're doing. So will they end up building destination stores like the Samsung store by the High Line in New York? I don't know. It's what they should do. They should have fewer stores that are bigger, like seriously, 3/4 fewer stores, but bigger experience-based stores where you can go into this GameStop and try a virtual reality game and then download it. But you have to be a member of the club, sort of thing. And if they did that, I think they'd just kill it. You know, I mean, think about the places that you've gone just because you wanted to see it. GameStop stores have to be a place where you go because I got to try this game. I want to see this thing. I want to try this experience. The Samsung store, if you're in New York, in Manhattan, go to the Samsung store at the end of the High Line. I'm telling you, you'll be like, all right, I get it now. So anyway, going back to CenturyLink, you know, money flow is down. It's near bottom. It's probably going to turn back up here. Is that a positive divergence here? The MACD, kind of, sort of, but it's
you
not
don't know where it's going to go.
Yeah, not a good one. But it is approaching oversold. I think you're really close to needing to buy more CenturyLink. You know, that dividend looks pretty stable. I think they're ripe for strategic business, you know, some sort of strategic transaction where they sell off a little piece. You know, they could sell off their consumer division and just be enterprise. You know, they could sell off their, you know, they could split into have two companies. One company could be a REIT, and the other company could be services. And I actually think that that's very possible. You know, if they took their fiber network and made that a REIT and then rented back from them, you know, you could see some pretty neat stuff. So when I take a look at CenturyLink, I'm not just saying, hey, it's a phone company and we got 5G coming. I'm saying it's a phone company with great assets and some strategic options that could really set that capital free. And I think CenturyLink gets back to 30 in the next couple of years, several years. You know, within our time frame, if anybody's not familiar, is we're looking for stocks that we're pretty sure are going to double in the next 5 years, in that 1 to 5 year time frame, but have a chance for a total return at a triple. And CenturyLink is one of those stocks. Now, we will relax that for some of the bluer chip stocks that we know the growth isn't going to be quite as high. But equity risk is equity risk a lot of times. So unless we truly are getting a huge margin of safety, we're looking for 3 times total return over about 5 years. And I think CenturyLink has that. I don't think they have any more beta, any more risk really than the S&P 500 at this point. Maybe it doesn't fluctuate exactly the same. You know, maybe they go up and down at different times. But really, the volatility is probably pretty similar. But CenturyLink is darn close to being a buy. Keep an eye on this. Try to see where this bottoms. See if it gets all the way down to 30 on the RSI. You know, does this MACD start to widen up, right? Does it start to get a bigger divergence on the MACD? Things like that. All right, I'm going to let you go. I am about to jump in a car and drive down to Marathon in the Keys. And everybody have a great week. We'll be back on next week. What did I say we were going to talk about? Earnings, right? Next week we're going to talk about earnings for a lot of our companies, why we think things are going to go the way they're going. See if my prediction that the bar has been lowered for a lot of companies, that a lot of companies are going to – they're still going to talk soft, right? They're still going to talk what ify. But I think they're going to get over their bars. Companies affiliated with Apple probably still have another down quarter. But as the new cycle for Apple comes back at the end of the year, I think you already can buy Apple. You take a look at Lumentum and some of the other suppliers. Look for their troughs. Because as those 5G phones come out in the next couple of years, if we can figure out who's going to benefit from that, there's a lot of money. Those are doubles and triples waiting. So that's something to keep in mind for 3, 4, 5, 6 months down the road, 7 months down the road. But just in the back of your list, bottom of your list, hey, don't forget about the companies that got beat up because of Apple. All right, let you all go. Have a great weekend. If you're in the snow, because I left. If you're down here in Florida, if you're in the Keys, try to get a hold of me. You know, I'm just going to be goofing off for the next 5 days. Let Dave hold down the fort. And, Dave, I hope you can get onto the chat room over at Margin of Safety.
Sure, yeah, I'll get on there.
And again, Fundamental Trends relaunch is going to be in February, and it's I've been looking at it. It's going to be pretty slick, and that'll be the one that has the bulk of our swing trading. All right, everybody, have a great weekend.
Have a good week, everybody.